All right. So, hi, everybody. My name is Rob Giles, and I am with the Corcoran Group. I'm actually filling in for a Miami-based person, but we're up in New York, and I'm here to discuss about real estate. We have several panelists who I've met before, Onic and the men that are becoming, I don't know if we have another woman coming on, but we're really here to dig down into the details of the real estate market, both in South Florida as well as across the country. And I just wanted to tell you a little bit about Corcoran. Obviously, Corcoran is one of the largest marketers of luxury real estate in the world. We're in New York, we're in Miami, we're now even in Lake Como, Italy, and St. Bart's. We're opening up across the country. I run a small team in Chelsea with myself and my wife, and we do about $40 million of property a year, which is not very large, but I really love learning about all the aspects of real estate and all the different verticals. So we're going to get started and have everyone introduce themselves. And I'm going to start with Onic because your camera is on, and I'm looking to you.
That's an excellent reason.
Yes. So Onic, why don't you just tell us a little bit about what you do and what you specialize in? And we'll get into the nitty gritty in a bit.
I will give a few minutes to the rest to turn on the cameras and get ready. So thank you very much, Marty, for the opportunity. Nice to see you again, Robert. So my name is Onic Palandjian. Unfortunately, I couldn't attend. I'm in Europe at the moment. Last minute, family office affairs brought me here. We are a multi-family office that invests mainly in real estate. 90% of our funds go to real estate, 10% go to technology projects. And we've been doing this for 37 years now. Contrarian, we identify best sellers from which we buy, and we've done residential, we've done office, we've done industrial. Now we're doing land, even in Manhattan, at really distressed prices, which is unbelievable. So we very much follow the adage, never let a good crisis go to waste. So with that, I'm going to wrap it up, and I can explain more in a little bit.
Fantastic. All right. So I see that we have two more panelists sitting down live and in person. So I think Peter Powers is first. Peter, why don't you just tell us a little bit about what you do and what you specialize in?
Yeah. I think first, thanks, Marty, for inviting myself again. I've been to a number of his events across the country. This is great. The last several ones I've gone to have been through my family's investment office, which is MPI Family Office. Since then, March this year, I started my own firm called SB Venture Partners. We're backed by a few dozen family offices from across the country and a few internationally. Just as the other Peter was mentioning, there's a lot of families and investors across the country that are looking to invest directly into real estate. They're writing 7-figure, 8-figure checks. They don't want to have to go through the Blackstones and Starwoods. They want to invest directly. And building, myself and my partner Sean have built relationships with families really across the country, and I've gotten to build that trust, and that trust has allowed us to start one of our private lending vehicles as well as our operational real estate investment vehicle, where we're acquiring senior housing communities and hotels and multifamily. Right now, we see a huge opportunity in the operational real estate, the senior housing, the hotels. Those assets got, valuations went up crazy from 2013 to 2020, and then they plummeted all across real estate, but especially operational real estate. When you think hotels, think senior housing. COVID really affected those asset classes. And then you look in 2022, just as the prices were going up, interest rates jumped back up. So they kind of had a 1-2 punch. So we saw a huge opportunity, especially in senior housing, where the silver tsunami is coming about. Over the next 10 or 20 years, there's just a huge opportunity. So we think it's a great time to buy these assets at really healthy valuations. We're under contract to buy a senior living facility right now from an institution at a 10 cap rate on trailing numbers, and we're able to finance it with 7.5% debt. So there's a nice spread going into it, buying at a nice valuation. And, we're grateful that we're younger. We can hold on to these deals for 20, 30, 40, 50 years. And I think that's the whole, that's the big opportunity in real estate. And we're lucky to, start this company at a time where there are a lot of assets that, have gotten beaten up recently that we can, kind of buy them, restructure the capital stack, and then, hold on to them for the long term.
Awesome. Is it San Ang? Can you pronounce your name for me?
Yeah, you're good. San is good. San. Hey guys, San Ang, Marty, thanks. Always great to be here. I'm with Skytian Capital. We started in 2000, so 23 years now. We do three things: real estate and innovation investing and nonprofit education. Marty, I met Tim last year here and just shared it. He's gone, right? I had the pleasure of interviewing him a few weeks ago for our book. And it's incredible. The Draper family has done 50 or 60 unicorns. So it's just a treat to listen to him. And for Jor, another Chinese here, Tim claims that his grandfather was a population expert and actually advised China at the time to do the one-child policy. So just some random stuff that's quite interesting about Tim and his family.
That was a mistake.
I know, he doesn't publicize that, but he talked about it for our book. So I'll talk about real estate. From 2000 to 2023, we did about 250 million in investing, about 180 of that's passive LP, primarily in CRE and multifamily, and about 70 million in GP deals, multifamily Bs and Cs. I like to focus later on the problem deals because this year we're being really focused on the 15% of deals that are not performing and what we're doing about it. So we can kind of dive into that later.
Okay. Marty, do we have any other speakers on right now?
That's it.
Okay, great. So really, I just want to dig into what's happening in the future. I know, here in New York, things have flipped. We used to have about 65% of the buyers financing and 35 paying all cash. Now it's pretty much all cash. Talk a little bit about the markets you like and the financing that you're using, if you're using any financing. Start with Onic.
Yeah, thanks for that. We are careful in the sense that in difficult deals, we don't over leverage. We used to, even in our 22 million square feet of commercial real estate that we have, the average is 55% leverage. Now the leverage in new deals is closer to 30%. So, and because of our reputation, we're able to secure, let's say, logical terms. But frankly, the deals that we do for land and ground leases, it's all cash. So you are correct in thinking that the market has shifted. It's evident. And the idea is, long term, let's buy it and then we'll refinance down the line. It could be in 3, it could be in 5 years. That's fine with us because the families that co-invest with us that are, half from the US, half from abroad, have this long-term patient approach, which works.
Okay, Peter.
Yeah, so we're seeing this from a couple different angles because we have a private lending arm and then we have our operational long-term investment arm. So as a lot of you guys have maybe seen, with banks, with institutions, the leverage has really slowed down drastically. For real estate investors, for developers, for business owners, we saw that over the last several months, last year with some of the banks going down. Banks have. And the government has really tightened up on the banks that they need to really watch their commercial real estate exposure. So we saw that, as an opportunity for us, especially between the $2 to $10 million loan size, where institutions just weren't focusing, and there was a few family offices, but they weren't really doing it on a programmatic level, where we were helping those business owners, those real estate investors, those developers, secure senior loans. We'll only go up to about 50% leverage, so it's not crazy high octane leverage, but it's better than them having to use all cash. So we've been doing that for the past year. We're actually putting together a $25 million fund to do a number of other deals similar to that across the country. And then we have our other side, which our main focus is our long-term investment side. So if you look at senior housing, you look at hotels, you look at multifamily, and then senior housing, to a certain extent, is blessed to have the agencies, so Fannie and Freddie. But as interest rates went up drastically, especially as a lot of these assets have been revalued, and they've prices have gone up drastically over the last several years, they're unable to get the same amount of proceeds as they were before. And then senior housing, Fannie and Freddie essentially have stopped. And then you look at hotels. Hotels, I mean, to get leverage on a hotel, you might be able to get 50% leverage. It's going to be high, single digits, if not low double digits interest rate. So there's a huge issue right now with a lot of these property owners where they maybe want to get out of these assets, the loans expiring. So we're coming into some of these deals. As I mentioned, we have a senior housing deal that we are going to be closing at the end of this month. It's about a $20 million deal in Charlottesville, Virginia. We're blessed where we have the capital. We're going to do a 50% LTV loan. We're buying this deal at a very nice valuation. Reset the capital stack, and then we're able to get a local bank to give us some non-recourse. It's going to probably be around mid-7% interest rate, 5-year term type of leverage. So we don't have to go in there with 100% cash. We have the ability to do so, but we're in a position where we're able to put more equity down and win a lot more of these deals when there's a lot of other groups that just don't have that ability. So, leverage can be great when it comes to increasing your returns, but it's also great right now because it's really increased our deal flow. We're seeing a lot more deals. We're able to, this deal we initially had under contract 5 months ago, $21 million or $22 million. We're going to close it at $20.6 million. So we're able to just keep knocking that purchase price down because the environment is getting tougher and tougher.
Great. So San, tell us a little bit about that angle, and do you finance and do you use leverage?
Well, we're real estate. We of course do. So I more or less agree with what Peter said. I think as per our beloved Mr. Munger said, it's about the value, right? So a lot of I guess new investors in multi, as an example, have basically taken hiatus or given up. The way we look at it is it's really the price you pay. So even in the Florida market where we're active, with insurance doubling or tripling, with interest rates, with taxes going crazy, as long as the price is cheap enough and we can cash flow with that, when the market turns back up again, we'll be making a killing. The issue is the price has not come down to that level yet. So, so this year we haven't bought anything. We've just been exiting. We've been, I personally have spent almost full time in most months this year focusing on property management. What that means is that of the 10 deals that we did in the past few years as LP and the 10 deals as GP, the deals that don't make it 100% is tied to poor property management. So in the past 6 months, we actually invested and helped build a very tech-savvy PM business out of St. Pete, Tampa. And we're actually looking to acquire and invest in PMs that execute with the view that perhaps second half of next year, when the pricing comes down to the levels that make sense with rate caps expiring, that we would be extremely excited to deploy.
Excellent. So let's talk about the fact that we're in a crisis. A year ago, we were talking about Armageddon. Is there a crisis now, and how are you taking advantage of it, and where do you see us in 5 years? So maybe some projects that you think are you wouldn't have looked at a year ago, but now you're looking at. So Onic, I know that you do a little bit distressed. Tell me a little bit about what you're doing.
Yes, happy to. So we used to do office,
right?
So that it doesn't get more distressed than that. So up until recently, up until this spring, we bought an amazing trophy tower in Houston, full, 85% full, with a vault of 7.5 years, fully renovated. The construction cost, the replacement cost is 350 million, and we bought it for 104, just to give you the flavor of the market. So you can find amazing deals. Right now, we're doing some ground leases. The first one is in New York. So effectively, we're finding a funding gap. Developers or people that want to redevelop a property cannot go and borrow as much as they could. And if they can, it's at higher rates. So that leaves the opportunity to either give them a mezz loan, which we do not prefer, or to buy the land and lease it to them for 99 years, which is an amazing thing because we can source such deals at a 6 cap. And when things normalize, when you're talking about Manhattan land, it's closer to 2 cap. So it's a way to triple your money, and at the same time you have nice passive income for 99 years, which is fantastic to be packaged and sold to an insurance company, to a sovereign wealth fund, to one of these investors that are looking for predictability in cash flow that always beats inflation. So you cannot find these deals in normal times. You can only find these deals in this kind of strange times. And similarly to the other groups, we're lucky to have families that have been with us for many years. They believe in what we do, and they continue co-investing with us. And I mean, we typically deploy between 10 and 15% of the equity, and other families co-invest with us. So yes, we do find very, very interesting deals that, 5 years down the line, we will be thinking, wow, how did we manage to secure those?
Cash. Excellent. So Peter, what are some of the things that you're looking at, and maybe where will you be in 5 years? Are you looking at anything other than senior housing? I think you mentioned some things.
Yeah. So I think, again, taking a step back, we underwrite deals, 5 to 7 years. Our goal is to hold on to a lot of these deals, especially if it's newer vintage within the last 10 years. We want to hold those deals hold on to those deals for 10, 20, 30 plus years. I mean, we look at every deal like a business. If you find a great business, you're able to structure it, where you can structure it with, 5, 7, 10-year use financing debt, where you're able to, get through tough times, hold on to that deal. If you have to, refinance it, hold on to it. It's hard to find great businesses, so why sell them? So, I think you mentioned, Charlie Munger passed away. That's the biggest thing is, hold and invest for the long term. And I think we're blessed in the sense of, myself, my partner, our advisors are younger, where we can invest for the long term. The families that invest with us are investing for their second, third, fourth generation. So buying right is always, is what you got to look for. And I think right now there's a lot of opportunities in senior housing. You're starting to see a few pop up in multifamily. I guess we're lucky that, Fannie and Freddie are still in the market to provide liquidity. Hotels, I think there's a huge opportunity for hospitality. The select service hotels, there's a huge opportunity to buy some of those from operators that are tired, that, bought these deals 10 plus years ago, went through COVID, it was tough, and they're now able to recoup, their money. So they're willing to sell, assets at, crazy discounts. But again, you got to be willing to go in there, maybe buy it all cash and finance it after. Because, right now the financing for hotels has been pretty tough. You might buy a hotel at a 10, 11, 12 cap rate. I think I saw one in St. Pete recently sell for a 12 cap rate. And you finance it with fixed rate debt at 9%. I mean, hospitality is cyclical. I don't care if it's business, I don't care if it's leisure. Next year if we're in a recession, or in 2 years if we're in a recession, that 12 cap might go down to a 6 or a 7 cap, and now you have negative leverage. So you really got to keep an eye out for that. So I think there is an opportunity in the hospitality sector, but you need to be very mindful of how you structure that deal. Again, you buy a great business, you know, if you structure it the wrong way, you're going to get yourself in hot water. And we're trying to avoid that. So we really, really need to get the hotel at a really low or a really big discount for us to feel comfortable. So that's why senior housing, we think there's more opportunity there right now, but we're still monitoring multi as well as hospitality.
Amazing. So let me ask another question. We heard Peter Lewis give an overview, which was kind of like drinking from a fire hose, but it covered a lot of different areas of the real estate market. Has anything that stuck out for you that's really important for our panel, our audience, about what we should be focusing on, you know, even 10 years, 15 years down the road? For instance, environmental issues. He talked about solar. He talked about the demographics of the country and what people are moving for. We talked about work, any of those things. If you want to pipe in, please.
Yeah, I think I'll just add one thing. So before I started this new company, I was helping my family lead more of a workforce housing initiative where we were buying lifestyle properties, converting hotels to apartments. And this kind of goes towards what Peter was discussing when it comes to you're not going to just see everyone go into assisted living. There were a tremendous amount of seniors that were renting these hotel conversions and these LIHTC properties. We thought it was going to be the millennials, people that just graduated from college that wanted to move out of their parents' homes. But it was between 30 to 50% of the property was people in their late 60s, early 70s. And that was surprising to us. So there's a huge opportunity, I think, if you're able to provide workforce housing that is catered towards that age cohort. So that's something that he mentioned that stuck out to me that we were actually seeing play out. So I thought that was a good point.
I want to echo, I echo this, and I also want to add that technology will bring a lot of disruption. We've seen what prop tech companies are doing now, and they're really shifting things around. So I think a lot in the real estate industry is ripe to be changed, so it's going to be totally different in 20 years. We're going to see a lot of developments being mixed use. We're going to see a lot more environmentally friendly buildings, copying what is already happening in Europe. We're going to see people caring more about sustainability and ESG and less about the bottom line. So that's my 2 cents.
Yeah, I want to add to that. Only you kind of stole my thunder. I kind of lived through and invested through the TCP/IP internet days, spent 3 years doing blockchain and crypto. But I think the AI robotics is by far the biggest impact and the most exciting for me in my lifetime. So, and I am like child in a candy store. I'm so excited about the implementation and impact using AI robotics in the real estate sector, because like healthcare and government is just so slow. I mentioned in the past 4 years, we probably have screened 4 or 5 dozen PMs, property managers, and through our portfolio, we maybe use a dozen. No disrespect, but the vast majority are technically moronic in terms of so much technology not being used. So we are actively investing in AI automation. As an example, some of the stuff we're using AI machine learning to do a lot of pricing for our flex leasing products. Really, really deep diving into that. We have a small team that really tries to put together data to help price our assets. This month in our South Tampa community, 135 doors, we're rolling out an AI chatbot and an AI voice system, so that when they see the listings from Zillow, they come to our website the chatbot is actually hooked up to the property management system. Hey, I'm Janet, what are you looking for? Janet, the AI would then motivate you to call Janet, the voice AI, and Janet becomes the tenant's lifetime customer service rep. And so we're rolling that out where really the only time that the tenant sees a live person is during the tour. Pre-tour, post-tour, post-check-in, it's all Janet handling that tenant. So there's just a whole host of these types of technologies coming out. As soon as Elon rolls out the Optimus bot, we're going to buy a dozen of these, because in that same community in Tampa, we're spread across 13 buildings. We have a full-time person just collecting garbage in the facility. I would love to have a Tesla bot working 4 shifts a day to be security guard and garbage collector, right? So I'm just super excited and looking for more opportunities to help asset manage and property manage.
So the whole disruption that you're talking about for various reasons, for technology and the environment, what sectors do you think are going to be big winners and big losers as far as the verticals? So for instance, we all talk about residential, but residential in New York is tough. A lot of people talk about the smile states and how people want to move to Boise or Nashville, and that's an employment focus. Tell me a little bit about how big employment trends are affecting your decision making.
I can tackle the first one. I think the impact on tech is pervasive across all asset classes. So we're trying everything. With 15 units in St. Pete, and we have put sensors on everything. Sensors in the room, sensors in the boilers. We even are testing a sensor in the mailbox, so that with an app that we're using, we can basically track the heating systems, HVAC, and the LED lighting. So it really is a data play, right? If you have a commercial building, you've got sensors all over it. It basically can tell you a lot about how to manage that, reduce costs. So I think it's pervasive, the tech side. It's a matter of, it's quite challenging because the folks that are helping us manage the properties are, again, just normally not that tech savvy.
Okay. Anyone else?
Yeah, I can chime in and use another example. Office, which, office is dead, and that's what a lot of people have said due to work from home and us all loving to be in our pajamas and having a second and a third job, especially if we are software engineers. You've heard the stories. What we see, and again, we are large owners of office, is there's a big difference between office and premium office. So only 9% across the US, only 9% of offices are either new or renovated or have the amenities. And 50% of the tenants go to these offices. So there's a huge difference between, let's call it premium office and the rest. And, demand is shrinking, of course, but supply is shrinking even quicker because a lot of these offices being reconverted into, some of it is residential or mixed use, some of it is obsolete. And so you're left with a much less office supply and much less office demand. But if you're at the premium of the market, you're doing just fine. Even in New York City, that has been in the news, or San Francisco, the top buildings, if you take, Vanderbilt or One World Trade Center, and they're all full, and they're asking for increased rent. So there's nuances into what we read as news, and we need to understand this before we jump into an opportunity.
one thing, just to kind of piggyback off what he said, I mean, the real estate we focus on, I guess from a high level standpoint, I have a good idea what's going on with the office, but I focus on more of the housing and the hospitality, but we're focused on asset classes that have demand that is just, going up to the right. Yeah, I don't think myself or the families, I can speak for a number of them, would want to invest into an asset class with demand going down drastically. Even if supply is coming off, that's just not, we look long term. So what does that look like in 10 years? What does that look like in 20 years? What does that look like in 30 years? Maybe you're able to do some nice trades right now, but I just don't see that as a long-term play. So I guess kind of what you just said on it, can you help me understand, 20, 30, if you're, the families you represent, how do they feel when they're looking out 20, 30 years when you have an asset class, specifically in America, where you're just seeing the demand just drop off?
Sure, with pleasure. You're buying 10 cap deals, something that's 85% full, it's renovated, and just because you're buying it at such a good price, just the guaranteed cash flow from the existing tenants effectively gives you back all your investment. If plan B or plan C is to convert it into mixed use, you can do that. But again, we do our underwriting in a very risk-averse way. We don't chase themes, and that's part of being contrarian. Is you need to take risk. You need to go where others are afraid to go, and that's why you can find 10 cap deals. Before you said hotels at 12 cap. Hospitality we don't touch because it's a very difficult business. It's not just real estate. It's real estate and operations. So happy to take this offline and share with you a deal so you can appreciate the kind of careful underwriting that we do before we proceed.
Who's your end buyer for that? I can appreciate what you said, but I mean, you're buying it. I mean, institutions are stepping away. Usually, they kind of set the trend, right? So, I mean, I think that would worry the families, myself, my company, but also the families you represent is, okay, who are we going to sell this to? We buy it at a discount. Like you see some of these office buildings selling in San Francisco, previously sold 5-10 years ago for $200-300 million. They're selling for $40 or $50 million, which sounds great. But your carrying cost every single year, could be $10-20 million. You might have to hold on to it for 20 years, before you even potentially.
If it's empty, you're absolutely correct. If the building is empty, you have a carry cost. So to quickly respond to your question, we started investing in the mid-'80s, just after the savings and loans crisis, and we used to buy in Texas residential properties, and everybody thought we're absolutely crazy. We were buying them at 20 cents to the dollar. Everybody said exactly what you said right now. You guys are crazy. And we sold 3,000 doors a decade later, 5x our money. We did the exact same thing in the French Canadian parts of Montreal, Quebec, during they had the referendum of potentially exiting. Everybody thought it was the end of the world. The Bank of Montreal still has its head office in Toronto. But still, if you buy at good prices, we sold 7 years later to a REIT, to an ambitious REIT called BTB. That was a 3x on our money. So to quickly answer your question, if in real estate, you make money the day that you acquire. If you make an acquisition at the right price, A, you can be forgiven lots of mistakes, and B, chances are you're going to be able to sell it at a logical cap rate. If you bought at a 10 cap, why not sell at a 7 cap, 3, 4, 7, 10 years down the line? And while you wait, you're getting, very nice yield. So that's the play. That's our approach. Of course, it takes guts and careful underwriting before you dive in. And of course, also not being over leveraged, having always enough cash to sustain any kind of turbulence.
Amazing. So thank you. We're going to leave it at that, and we're going to open it up to any audience questions. Marty, can you tell if anybody's asking questions?
I don't have anybody online asking, but we have one in the audience here.
Okay.
One thing not mentioned is healthcare facilities. What does the panel think?
Any thoughts on healthcare facilities?
As in medical office or as in like senior living facilities?
Hospitals, offices, nursing homes.
Yeah, so I think just a number of different, I guess, types. I guess my family has exposure to medical office because that's where my family made their money was in the diabetic care facilities. So I can definitely speak, Tampa Bay as well. I can tell you that all across Florida, especially, you're seeing these medical office, these buildings, and these hospitals are buying out a lot of these practices. So I think there's, I think it definitely has bones. I mean, as people need healthcare, that's something that they're going to need for the long term. So on the office front, I think it's from the exposure that my family has and what I've seen, it looks to be a pretty interesting asset class. With the senior housing, again, going off what Onic said, you make money the day you buy. So when something has gotten beaten up so much, and you're able to buy it at a really healthy valuation, you're able to structure it for the long term. I think the rest of it will kind of take care of itself. As you look again, I mentioned the demand. You look at the they call it the silver tsunami, where you get a lot of these. I think it's 10,000 people are now turning 70 years old every single day. It's just giving you a lot more demand. So you go into some of these areas, like I mentioned, the asset we have under contract in Virginia. There's nothing that is under development. It costs so much money to develop these communities that they were to develop one, unless they got some state grant or something to do it. Their costs to make sense are going to be, their rental rates are going to be so much higher than ours. That's just going to be, a tailwind for us. So I think it's a great time to start investing into that asset class. And then nursing homes, that's a whole different thing because now you're dealing with regulations. So I can't speak as much towards that because, we like to focus on the private pay, senior housing. That's assisted memory care, independent. We don't really do anything with the nursing homes because of the regulation. That's more of a business than it is real estate.
Last closing comments, please. Sam?
Not much else to add. Just glad to be here, Marty. Thank you.
Fantastic. Thanks so much. Onic?
I want to reiterate that let's not leave this fantastic crisis go to waste. We need to take advantage of it.
And Peter, you want to close up?
Yeah, I'm going to reiterate what I've mentioned. I think there is a huge opportunity right now in operational real estate, so hotels and senior housing. Right now, senior housing and hotels kind of went through their own recession. I think values have gone down drastically. There are a lot of REITs we're seeing right now that are just unloading the assets, and you can go in there with a great operating partner that understands how to manage these for the long term, and also kind of fix some of the problems. Right now, staffing has been an issue, so if you're able to kind of alleviate some of the agency staffing, there's you can make a lot of money, and you can provide a great place for people's parents and their grandparents to live.
Just to ask that, in the multi-space in particular, I think those of us that do invest in this space are salivating over the rate caps expiring. It really isn't as easy as that sounds. The deals that are performing are actually okay. The deals that are not performing are the ones that have poor property management. So if the idea of family offices here, investors to pick up these pieces later on at a discount, the second question is who's going to manage it? That part is very critical because if you have to turn it around. So, but with that piece in place, it's a great opportunity.
Well, great job. Thanks so much, guys.